We've entered a new era for raising capital. The benchmark isn't a treasury yield, it's not SOFR, and if you think your competition is the building across the street, you're already behind. The real hurdle rate has moved, and if you don't know where, you're about to find out the hard way. Today, I want to show you why the game has changed and why the new hurdle rate is not SOFR any longer. It's Bitcoin and a new class of preferred stock offerings that are paying 8 to 10% a year and don't carry any of the risk that real estate does. For decades, real estate could justify lower returns because it was seen as the most reliable store of value. Investors would take 5 to 7% annualized returns because they were expecting the appreciation on the back end. Well, that era is coming to an end. I want to start here with spot Bitcoin. And I know using Bitcoin's 60% CAGR as a hurdle rate sounds insane to most of you, but I think it's important that we look at this objectively. Bitcoin does not carry any of the risks that real estate does. You're not relying on the full faith and credit of any government. Its monetary supply is fixed, pre-programmed, and immune to debasement. It's the most secure computer network in history, and it's outpacing every other asset on Earth. It's the most certain thing in an uncertain world. So in that context, why wouldn't that be your baseline for evaluating other investments? When something like that exists and it's accessible to every investor and every human being on the planet, it becomes the benchmark. If you can't beat that return profile, investors are going to look elsewhere. Okay, I get it. You're not quite sold on spot Bitcoin as the hurdle rate, and that's fine. There's also a large segment of the market that relies on the income that real estate provides. And here's where it gets even more competitive. Right now, available to any investor are preferred stock offerings that provide income based on Bitcoin. The company that issues them is called Strategy, and there's 4 offerings. The first one is Strife, STRF, Stretch, STRC, Strike, STRK, and Stride, STRD. Now, quick disclaimer, none of this is financial advice. If you want to dig deeper, and I urge you to do so, Strategy's earnings calls are free on YouTube, and the guys over at the Hurdle Rate and True North are putting on an absolute clinic in corporate finance. They make it understandable and digestible for the average person. Okay, now let's get back to these offerings and why they're important. They're paying 8 to 10% annually in cash, either monthly or quarterly. They're senior in the capital stack. They're 6 times over collateralized by Bitcoin. That means there's approximately $6 worth of Bitcoin for every $1 owed to investors. And they're liquid. There's no multi-year lockups. There's no waiting on an exit. So when you stack this profile with 0 operating headaches, no tenant turnover, no CapEx surprises, and no political curveballs, the competition gets real stiff real quick. These products are regulated and they're available right now. So I want you to think back to the strategy I laid out in my very first video. Creative capital structures was a key pillar, and I introduced Bitcoin treasuries and dual collateralized loans. Now I want to take it one step further. I can see a scenario where a property owner begins holding their US dollar reserves in a vehicle like Stretch. They're collecting 9% a year and it's paid monthly. If you're going to park that capital in a regular bank account or even treasury bills, that's capitally inefficient. It's kind of like watching an ice cube melt on a hot summer day. For decades, real estate had almost no true competitor that could offer yield, capital preservation, and appreciation. Today, we have one, and it's not just one. It's an entire asset class that's emerging in real time. So what does that mean for you as a GP, a fund manager, or a developer? It means that your investors now have a risk-free alternative that's paying 8 to 10% a year and doesn't carry any of the risk that real estate does. That is the new floor. If your pro forma is showing 5 to 7% annualized returns, the capital's tied up for multiple years and there's various risks along the way, good luck. That model doesn't clear the bar anymore. So if your deal is not offering at least 11% annualized returns, net of fees, you're gonna have a very difficult time competing for capital. And yes, let's pause there. I said 11% net of fees. That sounds like a big leap from where we are today. That's because it is, and that's exactly my point. We are in the early innings of a secular devaluation and recalibration of real estate assets. The good news, there's a playbook, and I'm sharing it here with you. Bitcoin treasuries and dual collateralized loans can help offset that devaluation and act as a counterbalance. So as that monetary premium gets drained from real estate, it can be recaptured through the Bitcoin appreciation. So once again, we are using this new tool to complement the real estate asset rather than replace it. So if you want to raise capital in this environment, you need to know who your competition is. And again, it's not the building across the street anymore. It's these products. They're here, they're real, and they're already absorbing investment dollars. Bitcoin has changed the game and it's only getting started. So as an industry, we need to acknowledge this and we need to confront it head on. What's unconventional today is going to be table stakes tomorrow. What it means to be successful and profitable in real estate is already shifting, and it's only going to get exponentially more difficult to achieve. So as always, I want your feedback. Please drop your thoughts in the comments or DM me. I'm also going to ask you to share this. Please share this with your clients. Please share it with your team. Share it with your investment partners. I need your help spreading the word. I appreciate you stopping by, and I look forward to seeing you here next time.